Hey everyone, we're going to do a video today on post-election, or kind of sort of post-election, and parabolic moves. We're mainly going to focus on parabolic moves though, because I think it is a great point to make here in terms of investing. And then we're going to flip the coin on investing and talk about trading a little bit too, just because I think it'll be really important for everybody to kind of understand how these moves get generated, why some of these moves in these stocks are the way they are, and what it means. Like what type of investor, what type of trader is entering at these prices. So let's get started. The first thing, I'm just going to read off the email I sent, and then we can go from there. So, investing in equities and stocks come with levels of risk. Value companies tend to have lower volatility risk due to stable levels of revenue and profitability. Also, many pay a dividend, which is a qualifier to be included in many mutual funds. Growth companies are more geared towards generating top-line growth, with the idea that down the road, once they hit a certain threshold, they will be able to adjust and become more profitable. Many software companies, for instance, are considered growth companies. The golden rule, buy low, sell high, applies to both types of companies. But the problem is that many of these growth companies over the last, say, 5 years are going up hundreds of percent, and even more are going up hundreds of percent just this year. In low interest rate environments, which we're currently in and have been in for quite some time, growth companies will tend to lead. This is because low interest rates allow companies to borrow cheap and fuel future growth. We've been in a low interest rate environment for a long, long time now, and the pandemic only exacerbated these low interest rates by pinning them to historical lows. When assessing risk, you have to first assess your risk tolerance, meaning what percent loss are you willing to see in your account at any given time, and your holding period, your time horizon, as planners like to say. How long are you willing to hold it for this investment? If you're excited about Tesla becoming a profitable company, the last 5 quarters, I believe, have been profitable, and you want to invest, at what price is a reasonable price to do so? If you are invested in Tesla when it was 200 a share, might as well pull up the Tesla chart here so you guys can see what I'm saying. Now remember, Tesla did a 5-to-1 split back in August, okay? So it was 5 times more expensive than this, so it was around $2,500 a share pre-split, just so you guys can understand. So if you invested in Tesla when it was 200 a share pre-split and hold for another 10 to 20 years, you are very likely to be extremely happy with your investment. If you invested in Tesla pre-split around 2,500 a share, which is about the top, then you just took 12 and a half times more risk than investing at $200 a share. Understand, in the long run, it still could pay off. You could still make a lot of money investing at these valuations, but you took a lot more risk to do so, and you will receive much less of a payoff than if you had invested at $200 a share. The main problem with investing is that human nature is counterintuitive to good investing discipline. When it comes to trading, buying high, selling higher works all the time. But then you have to ask yourself, are you a trader or are you an investor? So I want to just start with that because I think a lot of times what gets you into something, and what we're going to do here, we're going to pull up the good old sentiment chart. Let's pop this open here. Yeah. That is not big enough at all. Sentiment cycle. And that that's better. All right. Let's talk about this for a bit. So this is one of the main things when it comes to investing. You really want to know where you are. And when you're looking at charts like Tesla, right? Tesla's been through many of discouragement phases. So let's just take a look at Tesla throughout its history. So probably started back before 2010, but went public in 2010. Goes up a little bit, then goes sideways for 2 years. Finally, in 2013, breaks out, goes up as high as 677% by 2014. Pretty sweet, right? From there, it gets stuck in a box. So it goes up from here to there, 677%, and then just goes sideways. And it goes sideways for about 3 years. From December 2016, catches a nice move up 111%, but then again, it goes sideways, right? Then finally, so it goes up, goes sideways, comes back down, tests to see if there's any buyers down there. There was, and off to the races. From June 2019, which was the kind of sort of more recent low of those consolidation phases, it is up over 1,000%. Just from this year's March low, it's up almost 550%. What you see on the right side of the screen here, and I think I've explained this before, what this is called is volume profile. The idea behind this is to show you where buyers and sellers have bought and sold the stock and at which prices, right? So I can make adjustments to this where it's every single 10 cents or every single dollar or whatever. But this is how I use it. So what you're realizing here is that from, say, 2013 all the way to 2019, you've been in just about the same range, right? Finally breaks out of that range a little bit, but then it comes back into it and then finally off to the races. These are all your buyers and sellers. These are what I like to call the value investors. These are the people who hung around. If you bought it in these boxes, and if you were even lucky to buy it earlier than that, but if you were to buy it in these boxes, right, you're a value investor. It means that you were buying when it was not exciting whatsoever. I mean, yeah, you had a couple of nice runs here and there, but if you were buying here and you're still in it now, that is the way to do it. And it's not fun to hold it through these periods. It's not fun to hold it through these periods at all. But if you believe in the company and you have a long enough time horizon, then that's like the point of investing, right? The point of investing isn't to get a quick buck. The point of investing isn't just to jump on in something that's going up. The point of investing is you wanna find companies and stocks that fit your criterias, that fit your risk tolerance, that fit what you're trying to accomplish, right? Like, are you just trying to invest in dividends because you want a steady income, or you invest in growth companies because you want appreciation in the stock in the company? Tesla's a great example because there was a very long period of time where you weren't doing much. And right around here in June of 19, I want you to think of something real quick. Let's say you were to buy somewhere in 2013, 2014, and you're holding it, and then like you get a little bit of up and it comes down on you. Get a little bit of up, comes down. And every time this gets up, it starts getting sold on you. And now most people kind of get the idea of what Tesla's been through, right? Like Tesla wasn't, like, many people thought Tesla was a fake company. Many people thought Tesla would never be profitable. They thought that Ford and GM and all the other major car manufacturers would just rip their tech and make millions of vehicles that were EVs, and that would be it. And then Tesla would just be, a thing of the past. So there was that's what a lot of this gyration and volatility is about. It's a lot of the people thinking it's a great investment. It's really one of those stocks, one of those companies that created kind of like a cult following. But let's talk about this here. So it created a cult following, and that means there's people on both sides of it. And so you bought it in 2013, and you hold it all this time and you haven't made a lot of money, and it's just starting to burn you out. And finally, you get this kind of period between, say, like December of 2018 in May of 19, and it's just brutal. I mean, that's a brutal. These are weekly candlesticks. I can even do monthly, but the point will still remain. It's a brutal period of downward slow movement there, and it probably ended up knocking a lot of people out because you could see the volatility, which are these the volume, which are these bars down here, ticking up as it's going down. So you finally wiped out a lot of the buyers, a lot of the people who had bought back in 2013, and what you did is you found a lot of sellers up at these prices. But once you get rid of all the sellers, right, there's really only one way to go, because now it's only people that are willing to buy it. So that's really what we're seeing here. So it starts making some progress, and it starts making progress. Bars are ticking up a little bit, but right around here, right, you got January really got going. February, it ticked up to almost 200 post split. Huge volume bars. Comes all the way down to 70 post split, and then off to the races. What you need to understand is that once you get above these markets, I like to call them, because these are where all your buyers and sellers are, the only thing you have left is price discovery, which means people who are willing to pay, who have no idea what they should be paying for Tesla, but they see it going up and they're going to pay whatever it costs to get in. And that's what this is on the way up. It's complete enthusiasm phase and returning confidence. So what you see here is during the period of this is when all the late buyers, late investors, late traders are coming in willing to buy it at any price. It's a sign of enthusiasm. And that's what you're seeing here. What's really interesting, and I'm putting Tesla in my consolidation category. But you can consolidate in two ways. You can consolidate by price, which means coming down, or you can consolidate by time, which means going sideways. Tesla very much looks like it's consolidating by time, going sideways. The one thing I would be pretty concerned about here is that if Tesla doesn't make it above, say, this 465-ish area, right? If it doesn't take out this box, what it's going to do, it's going to build a roof above it, right? And then all of these people who thought it was a good idea to invest up here, they're going to be future sellers when this thing comes all the way back down. Doesn't mean that's going to happen, but it happens many times throughout history to many companies, good companies and stocks. Let's get away from Tesla for a second. Let's look at some of the really high flyers. When we talk about parabolic moves, we talk about really, I think you've heard me say standard deviation, right? So how many standard deviations are you away from the mean? And what you're seeing here is C Limited. Again, a little bit, you get a little bit of feel like it's a little bit like Tesla in a way, right? You get these periods where it gets up, consolidates, gets up, consolidates, and then off to the races. Well, it got going, consolidated down, got going, consolidated. Now it's taken on a completely different angle. When I say the word parabolic, this is exactly what I mean. What you're doing is you're bringing in late buyers, late investors, late traders, and at some point, the people who thought there was no price too high to pay for C Limited is going to get washed. Same thing with NEO, right? Deservedly so. Once it broke out of its IPO range, it has a really nice move upwards. But stocks don't just keep going up like this. Okay? It does not happen. To bring that to make a better point of that, let's look at FSLR. First Solar is actually a really good example of a company that had high hopes back in the early 2000s, and now that we're in the 2010s, 2020s, spent a very long time under the magic 80 number. And so it spent a long time building all these buyers and sellers in this range. What you're going to notice, though, is that FSLR doesn't look too different than... I don't think SE's been around as long, so we're just going to get rid of that. But it doesn't look too different than the early days of SE, right? You get the period of just going sideways, up, kind of starts making a little bit of run, then really gets parabolic. What's interesting is that FSLR got absolutely destroyed here, right? Down about 50% from high to low back in 2007 to 2008, and then finds its way back up. But look at this. If you were to look at this, right, returning confidence, enthusiasm, buy the dip. Returning confidence, enthusiasm, buy the dip. This has happened to Microsoft, which is the one I always go to because it's really cool to look at that. Right? Returning confidence, here's your enthusiasm phase. And then once it breaks down from there, that's all she wrote. And I always bring up Microsoft because, again, it was one of the best tech companies you can ever invest in. And if you bought too late, if you said to yourself, there's no price too high I'm willing to pay, you'd be waiting 16 years to get your money back. So the question you have to always ask yourself, are you a trader or are you an investor? If you're an investor, and many of the people I'm talking to on this email thread are investors with super long time horizons. We're talking about 30, 40 years in front of them of investing. I myself, I always think about this when I'm buying something. What is this thing going to look like in 10 to 15 years? That's like my starting point. And then from there, I say, okay, what could it possibly look like in 20 to 30 years? If you ended up doing yourself, if you ended up turning, let's say you got into Microsoft back in, around 2000 and you got in, you're like, hey, you know what, I'm going to buy it. And when it goes up, when it goes up, I'm going to get out of it. And maybe you didn't get out. And this happens all the times to people who are traders. It turns them into investors because it goes down and you really just want to break even at that point. And you never get the opportunity to break even. It just keeps making lower highs over and over and over again until it finally bottoms out. Let's look at a couple others. MYOK. This is why it's really important. Like, I don't understand. I'll never understand how people can invest without looking at charts. And people do. They do it all the time. Maybe they'll look at a 1-year chart or maybe a 2-year chart, but I can't even touch something without looking at like a full history, like the full history of stock price, right? Because you want to know where you are relative to all the prices that the stock has been bought and sold at, right? You don't need all the indicators. You don't need this. You don't need all the stuff on the bottom, whatever. You don't need these fancy things. You don't need that. But you at least should understand where you're buying it relative to where other people have bought and sold it before, right? If you see that, maybe it was down in the 20s for like 10 years and then all of a sudden it's up at 224. Well, does it make any sense to be buying it up at 224 right now? No, it doesn't at all. Are you trading it? Are you trying to get one last pop out of it? And that makes the FSLR case when you go back to here. You say to yourself, okay, I'm going to trade this thing. Everybody's getting in. It seems like there's nothing that can stop this train. I'm going to get in. Whoosh. Going to buy the dip. Goes back up. Make some money. And then all of a sudden what happens is maybe you get greedy or maybe you get down in the position a little bit and you're like, all right, fine, I'm breaking even. I'll just wait until I break even, then I'm out. And then what happens is you never end up breaking even. Okay? Lower highs, constantly seeing lower highs. And then what happens? You get into this period where you just get suppressed. And what all this is doing, what this action is doing in the stock is all it's doing is it's finding sellers. All the people who are crying uncle after they bought it above 100, bought it above 150, bought it above 200, bought it above 250. All the people who bought it up here, they're crying uncle down here. And so the top was in 2008. We are 12 years, okay? You better hope if you bought it, if you had let's say you were retiring in 10 years, right? I'm retiring in 10 years and I bought FSLR at 280. Well, you are retired right now. And this is like a complete loss of your portfolio. This totally puts pressure on your retirement timeline, right? If you think you were going to get 3,000 a month from your investments, well, now you're only going to get 2,800 because you decided to buy FSLR at 280 instead of say 50, right? So you have to really understand that. Now we're all very young, most of us on this. So we have 30 years to make this mistake, but you really have to ask yourself, at these levels, you're taking much more risk, multiples of risk compared to prior prices, right? So when you look at our favorite companies out there, you look at Peloton, for instance. Do I think Peloton is an excellent company? Absolutely. You're talking about a company that sells hardware, the bike, sells subscription models, the software, right? And is probably going to like link up with Tonal at some point. They're going to end up creating like the best home workout gym that we've ever seen. All digital, I can imagine it's going to be like the most incredible thing. It's a great company. They make money. I'm pretty sure they make money, don't they? Yeah. Oh, well, yeah. See, that's right. The first 3 quarters in the negatives, and then they started making some money. And that's when they really started taking off, right? So they're already profitable. A company that just IPO'd in 2019 is already profitable. That is a huge plus. Do I think this is a $200 stock at some point? Easily. Do I think it has some run room after this? What's really interesting too is that it all depends how you're looking at these charts. I think this is parabolic. I'd have a really hard time investing at these prices. In 20 years, do I think Peloton is above 125? If I wake up on Monday and I buy a slug of shares and I'm like, all right, well, in 20 years, it's going to be above 125. But I'm taking a higher risk at these levels, meaning even if it goes to maybe 150, 200 immediately, it can't keep up this pace. It cannot keep up the pace of going up like this. No company ever has, right? If you go back, if you look at like the NVIDIAs, I think NVIDIA is a good one. If I find NVIDIA's in the same boat as Microsoft. I mean, look at it now. Unbelievable, huh? NVIDIA is in the same boat as Microsoft, but I think it broke even a little sooner. So you buy it in 2000, 2001, you don't break even until, say, 2007, 6-year holding period. Gets up, but then you back down. So then you really, if you bought up here, say in 2000, you're still underwater all the way until 2016. So pretty similar to Microsoft. But then look, once it breaks these levels, off to the races, price discovery. The longer something is in a range, the higher and longer it's likely to trend. Right now, what it's doing is extremely impressive. It's breaking out of this range already. If you look at the market, I think when we talked in the last video, I said if it breaks these levels, that's not going to be a good thing. And look what happened, right back to the top of the range. What's going to be interesting, notice how it's consolidating there. What's going to be interesting is if it breaks these levels immediately, meaning takes out this high, the October 12th high. If it takes out the October 12th high, then we're back off to the races. But I was hoping we would at least consolidate sideways for a little while, but it doesn't seem like that's going to be the case. But we'll see. Next week is kind of a pretty key week. Let's look at a couple more. EMPH. Right? Monthly candles. That's absolutely parabolic. Could see 130, could see 140, but again, taking super high risk investing at these levels. You say, all right, Kyle, well, what's a possibility of what could happen after a stock goes parabolic? And I've mentioned these plenty of times before, and I think these are very good examples of what could happen. Coop, 2016 IPO gets up, 3 months of consolidation gets up. looks like 1, 2, 3, 4, 5, 6, 7, 8, say 8 or 9 months of consolidation, gets up. That's really good. Like all that is great. Gets up, consolidates, gets up, consolidates. This move out of here is a pretty big move. Here's the good thing. It's consolidating sideways right now, right? You get this big dip, 32% in 2 weeks. So you gotta like a little volatility if you like these stocks. 32% in 2 weeks down. Ever since, say, June of 2020-ish, sideways, just staying in this range. So again, this is similar to whatever the other one was that looks just like this. But if it doesn't get above this, say, 320 area pretty quickly, then it's heading lower. But this candle that happened last week, the weekly candle, I mean, that looks excellent. Excellent, excellent, excellent. This can easily see another leg. But this is what I mean by once something kind of goes parabolic, you want to see it consolidate sideways, right? Consolidate by time. If it's going to consolidate by price, it just gets more dangerous, right? Because you could start seeing things like this kind of wedges out a little bit, and then if it loses the wedge, it's game over. Then you turn into an FSLR or Microsoft, and you got to wait 10, 15, 20 years until you get your money back. So right now it looks fine. So let's look at another one that's kind of consolidating sideways. So Team, same boat, consolidating sideways, consolidating through time. SLP, simulations. This one is consolidating through time and starting to break out a little bit. So what's really good about this, if you were to compare this to Coop, compare this to Team, you'll notice the difference. So it's probably a bad way to compare it, but let's see if we can make it happen. So black is SLP, which is the better one. So SLP got up, created this kind of broadening pattern, and stayed above the middle. From a technical analysis standpoint, that means buyers are in control. On the flip side of that, Coop and Team, these both are a little bit weaker relative to SLP. They still have a little bit of work to do to prove that they're going to get up, get above middle, and get going. So SLP is definitely looks better as far as consolidating sideways. Okay, broadening patterns are awesome. In terms of trading, but even from an investor standpoint, if you catch one of these broadening patterns right now, not a bad place to enter. But these broadening patterns, really, what patterns are is just human nature, human sentiment playing out. People buying and selling very dramatically and not so rationally. So when you see this happening, it mainly means that there's a lot more entrance into the market. And if I didn't mention this before, 50 plus million new brokerage accounts opened up in 2020. 50 plus million. That's a historical amount of brokerage accounts. Every single person who couldn't bet on sports, every single kid who got a $1,200 check, people who got laid off and needed some income, everybody became a trader, everybody became an investor, everybody wanted something to do. This is a market that has tons of participants in it, and these broadening patterns signify that. They show you that people are buying and selling irrationally all the time, and there's going to end up being no price too high to pay until there finally is. I could see SLP at 100, within the next couple months. That will end up being the blow off top. There's no doubt about that. Let's look at another one. Shop. Shop is one that I always was using as parabolic moves up. What I say about these parabolic moves too is that on the way up it makes millionaires, on the way down it teaches everybody lessons. And so again, broadening pattern just like the rest of these, the ones that I've been going through: Coop, Team, SLP, Shop, and Tesla even. Consolidating sideways by time and looking good, staying above the middle. So the main point here is that I want to drive home the risk side of this. If you're buying up here, you're taking X amount of risk higher than if you invested, or if you had bought down here. Now that seems obvious, but the most important thing in life is time, right? So it depends on how much time you want to waste waiting for this thing to break even again. So you could see another 10, 20, 30% upside, 40%, 50% upside easily. You can easily see another, whatever percent upside from here. But to capture that 30, 40, 50, 60% upside, the likelihood that shop gets cut in half over the next, I think it's going to happen sooner than that, but let's say sometime in 2021, pretty high. Pretty high. That's why I forget which ones. I think TTD, I think I was mentioning that, like, yeah, okay, you're probably going to catch another 10, 20% up, right? Maybe hit the magical $1,000 number, but then it's going to get cut in half. And here's the thing, too. You have to understand this. We just stimulated $7 trillion into the economy. We're likely about to stimulate more into the economy. That is an extremely good thing for stocks in general. With interest rates at all-time lows, at historical lows that we'll probably never see again unless we end up going negative, which would be crazy. It's really good for growth companies. So every software company out there can take on as much debt as cheaply as possible and use that debt to fuel their growth. And they'll grow and they'll grow and they'll grow. And everybody's going to get very excited about that growth. And they're going to invest in these companies and they're going to pour all their money and invest in these companies. And what happens is at some point, inflation's going to tick up. And inflation won't tick up until we get back to full employment, until we get back to really steady, good GDP growth. I'm not talking about, like, when you hear GDP growth goes up 33%, it's the same people who look at like 2019 is the best year in history, or Obama's first four years is like the best year in history. It's like the best time in history. You have to understand. Like when the market goes down 50%, yeah, that run up is gonna look really good, but you still haven't really gone anywhere, right? Like 5 years from 2008, and you're just getting back to October 2007 highs, the highs of the global financial crisis. This is the same thing when people talk about like 2019 being the best year, and it was. Technically, 2019 was the best year in the history of the stock market. Best performance. The S&P went up, if I nail this right here, I think it was like 32%. I forget the exact number. It's not that. It's like 32% or something. Best year in stock market history. What people forget to tell you is that prior to that, the market was down 20%. So this move here, we were down 35% in March, up 56%, right, from the bottom in March. But really, we're only up about 3 or 4% year to date. Let me repeat that so you can slap people upside the head when they say stupid things. The market was down from high to low 35%. It has topped out at a 62% rally from the bottom, and we are only currently 3.5% above this year's high. And in terms of how far we've come from the beginning of the year, January here, there, 7%. So the market's up 7 or 8% this year. It could end really strong. I wouldn't be surprised if we're up 10, 12% by the end of the year. But the point I'm trying to make here is that, bear with me on that rant. The point I'm trying to make here is that a lot of these companies, you just have to understand that if you buy it now, you're just taking tons of risk. And even if you end up getting 10, 20, 30, 40% higher from here, just understand that you should probably treat it as a trade and not as an investment. You only invest in things that, like, you want to invest in things that have great potential, that you believe in the company, that they're doing something for you, like paying you a dividend, or they're a company that has a stable market environment, or whatever it may be. Those are the companies you want to invest in. Companies like I like this GVA, Granite Construction. If we get an infrastructure bill, this thing goes crazy. Summit Materials. If we get an infrastructure bill, this thing goes crazy. Investment banks. If you look at Morgan Stanley, great example. The difference between investment banks right now, what investment banks are doing since the March lows compared to like shitty banks like Bank of America or Citigroup, right? Look at that. So investment banks are going to do really, really well because, like I said, 50 plus million new banks, new brokerage accounts have opened up. The other ones you want to look at is retail. If this country opens back up, designer brands is going to end up doing really well. G3 Apparel going to do really well. Under Armour, if they get their company back in order, for the love of God, they'll do really well. Companies that have already done really well in the retail space is Lulu. But this is exactly the type of enthusiasm you don't want to see, right? So if you get, like I really think this is really just consolidating right now, like it is a software stock. Looks pretty much the same, right? I think we could see one more high here, 420, 440, easily. But then this thing is going to end up probably topping out before the other ones do, by the time the other ones even get going. So other retail names like Buckle, is it FIVN? 595 Below. Five Below is actually done really well. But retail names are going to end up doing really well under Biden. China and cannabis, so VFF going to do really well under Biden. CGC, IIPR, which I think is all-time high. So IIPR is the growth houses. That's not the right way to say it. The grow houses. So they invest in properties that house the grow houses. What other areas? So for Biden, so China is going to do really well. So Baidu is probably going to end up doing really well. Baba is going to continue to do well. If you look at VIPs, probably going to end up doing really well. So if you look at the FXI and EEM, so what these are, so I'll just stick with the EEM for now, but it's emerging markets. This thing has been in a range since, let's call it 2007, 2008. It's been in a range all the way since then. It looks like it wants to start, it looks like it's gunning to break out. Let me show you what happens when a sector breaks out. This is the semiconductor index. Makes a high in 2000 like many other things did, like much of technology did. You stay underneath for about 16, 17 years, you finally start breaking out. Once you break out, once you take out that prior high from all the way back then, off to the races, right? Now, the semiconductor index, you're thinking of like MU, which, I mean, look at the move MU's made since 2016, 537%, 450%, right? This thing looks like it wants to, I thought it was going to consolidate. I think it might not. This thing might just end up breaking out, gunning for the highs. If this thing guns for the highs, that more strength to semiconductors. Marvel, this thing's already gunning highs, which is incredible. But if you really look at it, right, this one ended up topping in 2006, just took out the 2006 highs this year. Now it's going to be off to the races, right? So there's a difference too. When you look at parabolic moves, you have to understand something. This thing went parabolic from 2003 to 2006, right? And this is what happened after that. You stayed down for 13 years. So just understand that the difference between what this move is and, say, looking at an SE is that SE has never traded at these prices before. right? Never traded at these prices, never seen these prices. This is full-on price discovery mode. At this point, all you're doing is bringing in buyers, and you're not getting many sellers, right? Bringing in buyers, bringing in buyers, bringing in buyers. If you go back to, what was that? Was it Marvel? Marvel. If you go back to Marvel, the difference is that there was zero price discovery mode until right now, above say 37, 36, 37. The reason is because we've been at these prices back in 2005, 2006, right? So there was probably some sellers up here, but there wasn't many because all of the sellers ended up getting drained out because they just got beaten down for year after year after year. Finally, all the sellers are like, "Oh, fine, have all my shares. What's left when there's no sellers? Buyers." Off to the races. So just keep that in mind when you're looking. If you're pulling up charts, you have to understand that like Parabolic in Tesla is a lot different, lot different in SE, in MPWR, right? Like a lot different. Nobody, no, there's no. This is all price discovery up here. So you're not looking at like a Microsoft. Well, Microsoft's probably a bad example, but from here, when it started climbing the ladder and trying to get out, these are all prices it's been at before, right? All prices it's seen before. Even when it came all the way down here, it saw those prices back then. Once you hit price discovery, these things can just run for a long, long time. So just keep that in mind. It's much different when you go like Microsoft. If you don't see anything from my cursor to the right, that was all price discovery. And then when it finally started coming down, now what you're doing is you're testing buyers to see if there are any, and there aren't. And now you're just draining out all the sellers. And then finally, when all the sellers are gone, you're off to the races. So just you really gotta keep a keen eye on that, because this SE, this is like 1999, 2000 Microsoft. Okay, so if you're really excited about your investment, that's great. Just know when to take profits. Okay? Just know when to take profits. You're not going to be able to hit a top. You're never going to buy at the bottom, and you're never going to be able to sell at the top. So if you sell here, just understand you might be giving up 10, 15, 20, 30, 40%, but you're saving yourself from huge downside and the opportunity cost of having to hold a loser or hold something that's kind of just draining you out over many of years. And that's really what it is too. It's opportunity cost. You want to be able to buy low, sell high, and then when you sell, put it back into something where you can buy low again, right? You want to be able to just do that over the course of your investing life. You do not want to buy high, try to sell higher, and then when you can't, when it doesn't go higher, or when you get one of those really bad weeks, one of those really bad months, now you're constantly questioning if you're going to hold it to break even, or if you're going to just hold it and become a really long-term investor. So hopefully this helps. We had some fun text thread on parabolic moves, so I figured I'd get this out there. Hope everybody enjoyed it. Hope this really gets you to understand that you don't need to know technical analysis. You don't need to know what patterns mean. You don't need to know any of that. The only thing you need to know is when you buy something for an investment, where are you buying it relative to where it's been? Remember, final point. Stocks should go up like this. That's kind of like the normal, go like 45-degree angle, right? Once they start getting like this, you're talking about weak hands. Every single one of these is weak hands. And once the big institutions decide to sell this thing, they don't sell 10, 20, 30, 50 shares at a time. They sell millions of shares at a time, and you will not be able to react by the time this thing loses 10, 20, 30%. You can just look at Coop again, right? In 1 month, 2 weeks, that's the better way to look at it. In 2 weeks, this thing was down 30-something percent. The next leg up that it makes, it's not going to just lose 30-something percent. So just keep that in mind. Let's see. Is there anything else? I think that's it. All right. Well, hopefully this was helpful for everybody. If you have any questions, shoot me an email, send me a text, whatever you want to do. Everybody enjoy the rest of your weekend, and good luck out there.